Welcome back everyone to a lecture on international political economy. I hope you enjoyed your break, you made the best out of it, and you're now prepared for session 7 concerning the global financial system. This week's unofficial motto is gonna be fear not. And I mean fear not in two senses. The first is that when we talk about the global financial system, about finance in general, about financial markets, there is often this idea that this is something that is so complicated that no normal human being can understand it, and it's something that we should leave to the experts to discuss. And this is something I do not believe is true. I hope I convince you of the opposite. I'm not going to say it's not complicated. It is complicated, and it's also counterintuitive in the sense that the way you have to think about money when you think about financial markets is very different than the way you think about money in your everyday lives when you try to earn it and spend it and so on and so on. However, if you try to think about it, then you will get the main ideas. And it's important to get the main ideas because financial markets in the current phase of global capitalism are a very, very important institution. And for us as citizens of one country, whatever country that might be in your case, it is important to have an idea of what is going on there, because there is still the idea that the democratic public sphere should in some way control and check what's going on in the economy, and that means that we have to do it in some part. And if you have to decide whether you're in favor or against a certain kind of regulation or not, it's better to have some idea of what's going on there, and I hope I will help you getting some idea today. The second sense in which I mean fear not is that even if you listen to the lecture now, if you read the textbook and you still believe, well, there's so much that I didn't understand, that's also okay. So it doesn't mean that you're too stupid to understand it, and it doesn't mean that you are a person who will never understand the way finance works, because, as I said before, it is something that is counterintuitive, and when it comes to understanding counterintuitive things, it's typically the case that you don't understand them the first and the second and the third time you encounter them and you try to understand them, but only after you think about them more often and you read about these things more often, then you get used to the way of thinking that's necessary there, and then you'll understand it better and better. And it's not only understanding it better, it's also getting used to the idea that it's different than everyday life is. So don't be afraid that it's something that's too complicated to understand. Don't be afraid that if you don't understand everything in the first run, it's nothing for you. Just try to get as much of it as you can. In the bigger picture, you see that we're now entering the second half of our lecture. So Pentecost break was the halftime break, and we're now entering the last 6 sessions of a lecture before we then head towards the exam. Today's session will be divided in 3 parts. First, I'll provide you with some concepts and basic ideas concerning capitalism, the state, and finance. This also contains some repetitions of things that I said earlier. Then I'll discuss the international monetary system, and finally the international financial system and financial markets. So let's begin with capitalism, the state, and finance. First of all, and this is something I said repeatedly, and I'll probably say it a couple of times more during the lecture, is that if there's one thing that's truly impressive about capitalism, then it is the amount of production that happens in capitalism, the amount of innovation, the rise in productivity. So under capitalism, we live in a society and we have an economy where there's definitely enough stuff produced for everybody to live on. However, not everybody gets enough of the stuff to live on, but that is a different story, and this is a problem that we can also think about. So I'm not reading the gospel for capitalism here, I'm not reading the gospel against capitalism here. I'm trying to give you an impression of how capitalism works and where it maybe doesn't work so well, so that you can decide and think and judge about it. So, and if you want to make a case for capitalism, then it's probably going to be based on the fact that it is so productive and innovative when it comes to production. So we can ask ourselves, under which conditions will capitalism successfully engage in this kind of massive production? And last week, or no, 2 weeks ago, I gave you all these, named all these elements that I would say that has to be there in order for capitalism to successfully work. And then I focused on capital last week, and this week I will once again focus on capital, but in a way that's a little bit different. So last week the general idea was we already had organizations or people who had a lot of capital and were then trying to invest it, and maybe invest it abroad, so in another country. Now we go one step further or one step back, depends on the way you look at it, and ask yourself, okay, how do people come about with these amounts of money that they need to invest? And this is where we have to look at the monetary system and the financial system, because this is something that I already told you more than 1 month ago, that in order for capitalism to work, we first of all need money, because it won't work if you just barter with stuff. And second of all, you also need credit, because without credit, generally no one would have sufficient funds to do all the investment that it takes for capitalism to work. So then we have to look at the monetary system and the financial system, and it is also something that was not really missing in the picture that I gave you last week. Rather, it's also part of what you could say that's the favorable political framework. So the state's politics have to supply capitalism with a stable financial and monetary system. So before I explain this a little deeper, then we have to train ourselves to think about some concepts and some dynamics in finance in a way that there are always some basic equalities, and I'll come back to some of these over the course of the lecture. So first you have to think, whenever there's a credit, so some money is added to your account, there will also always be a debit of the equal size. So for example, if I transfer you 20 euros for whatever purpose, the bank will subtract 20 euros from my savings account and add them to your account. So there's a debit from my account, there's a credit to your account, and it's always going to be equal. And now you may think, haha, that's not true what he says. I can also then go to the bank and then withdraw 20 euros and have them as a bill. And then there's only the debit. So the bank will say, well, you lose 20 euros from your account and there's no equal credit. And then you think you have one, but then I will remind you that you then have the 20 euro bill in your hand. And this, of course, is also your credit, because what's a 20 euro bill? It's a certificate that will say, well, you can use that to pay somewhere. And if you go somewhere and pay it, then it will change possession once again and the story continues. So whenever there's a debit, there's also the credit. This is how modern bookkeeping works, and it cannot be otherwise. This also is connected to the fact that whenever there is lending, there's also borrowing. So in case you borrow your friend 20 euros, then your friend lends 20 euros from you. That's just like the equal operation, just looked at from the other side. And this seems very obvious, but as I explain to you in a minute, when we think about the budget of the state, typically most people forget this instantly, that this is the case. So whenever someone borrows money, someone else has the opportunity to lend money, and it's always the equal amount there. Next thing, and this is also quite obvious, because it's also the same operation viewed from a different angle. Whenever there's a sale, there's always a purchase of the equal size. So if you use the 20 euros to buy something in the store, then you might make a note somewhere that says, okay, I bought this thing for 20 euros. And the store where you bought it, they would say, well, we had a sale of 20 euros. And so it's always an equality there. And if you look at an international scale, the same is of course also true for exports and imports. So if France exports whatever they export to the United States, let's say wine in the value of $1 million, then the United States will have imported wine worth $1 million from France, and it's always the same thing. And this of course means that the overall exports and imports globally, they are always the same thing, because for every export there is an import. And this is something that is important to remember, that there are these kinds of equalities within the economy. And one point where this also applies is something where we don't think about it this way in our everyday life typically, which is money and money creation. When we think about money, we typically think of it as something that has existence and that's out there in a certain amount. So just like maybe stones or cars, maybe better cars because they are produced. So a factory will produce 1,000 cars, and then we have 1,000 cars. And in a similar way, you would say, well, $1 million are created by the government, by the central bank, and then these $1 million exist. And this is true to some extent, and then they can circulate because they exist, just as the cars can circulate because they exist. However, if you think about how money is actually created in our modern fiat money systems, then it's also the case that for every money that's created, or for every amount of money that's created, there's also an amount of debt that is created. And this is not, there's no consensus about this. This is what's called the debt theory of money, or the credit theory of money, but it is quite plausible, and it helps you understand some things. So I mentioned that before, that there are basically two ways that money is created in our societies. One, and this is the one that is more important when it comes to the amount of money that's created, it's money that's created by commercial banks when they give a credit. So maybe you as an individual go to your bank and say, well, you know, the corona crisis was so hard, I need a credit of 2,000 euros, and as a security I have something, whatever. Or maybe your parents vouch for you, or there's a government program where the government vouches for students. So you go to your bank and you get the credit. And once again, when the bank gives you a credit, they will put down the same number in two different pages of a book, or in two different columns, or in two different accounts. On the one hand, they will say, well, we do give you a loan, and by giving you a loan, they will just add maybe 2,000 euros to your savings account. And then you can just withdraw it, and then the money is out there. However, at the same time, the bank will also write down the same number of 2,000 euros, maybe in a second account, where they say, well, this is the loan account of this person, and here we just put down the 2,000 euros. So at the same time, your plus 2,000 euros are created and your minus 2,000 euros are created, and in the end it all adds up to zero. However, you can just take the 2,000 euros and walk out of the bank and then spend it as you will. So this is one of the ways that money is created, but at the same time the same negative amount of money is created. The same thing happens basically when the second type of money creation takes place, which takes place when central banks issue money. And this does not mean that central banks just print money and then carry it out there in bags or whatever. It happens also in the form of credit, because central bank money gets into circulation if commercial banks lend money from the central bank, and the central bank defines an interest rate at which at which commercial banks can take loans from the central bank, and this is the way that central bank money goes into circulation. And it's the same story again. When a commercial bank will take money from the central bank will, on the one hand, note down the amount of such and such, typically it's not thousand, but rather millions of euros in the name of the bank that they can then withdraw and use to pay stuff. On the other hand, the central bank will also have a second account or a second page where they note down how much money this commercial bank owns the central bank. And now you might wonder, well, this is only stuff that happens on paper or maybe only digitally. What about the good paper money that I can touch? How does this come about? And it's part of the second kind of operation. So if the commercial bank has money in its account with the central bank, then they can say, well, we want some of this in cash because our customers want cash, and then it's they get it paid out as paper, and then it's subtracted from the account. So it's the same thing as it is with you withdrawing your 20 euros from your bank account. So in a sense, you could say that money is always created from nothing, and there's always the same negative amount of money created as there is a positive amount of money created. And here you must see that this is very different from stones and from cars, because it's not the case that for every car that, let's say, General Motors produces, they also produce a secret, dark, negative car that they will keep in their factory, and then the both can come together and can be annihilated. That's not the way cars work, but that's of course the way money works, because if you have this loan from your bank and then you bring them 2,000 euros because you want to repay your loan, then it all will be zero again and the money will have disappeared afterwards. Cars don't disappear this way. So money is something else than cars. In the next step, I want to discuss the main policy fields that governments can engage in when it comes to finance and financial markets. So I would distinguish three of them. So first, there is monetary policy. And monetary policy is the policy of money creation, and this is in present days always associated with the activities of central banks. And today there's this idea that central banks act autonomously, so it's not really something where the government commands, so the people that we elect then decide what happens there, but rather this kind of policy should happen according to the orthodox teaching at the moment, independent from politics. It's never truly the case, but that's the idea there. So this is the policy pertaining to, which means concerning money and currency. And what's the goal in these policies? Typically is that you want to have a stable monetary system to enable economic growth and low unemployment. Because as I said today, as I said before, in order for capitalism to work, we need a reliable and stable money system. So if the economy wants you to work for money, then you probably would want that the money that you sign up to work for, so maybe 1,000 euro per month, that they will still be worth 1,000 euros or roughly the same as the 1,000 euros today, next year and the year after that. The same is true for investment, the same is true for saving or selling stuff. So all these kind of calculations typically rely on the fact that money does exist and it will sort of keep its value, and it's also that there will be enough of it. And if all this works the right way, then you might get a stable economic growth and low unemployment. So what do you want to do for that? So first you want to give a sufficient supply of liquidity, so whenever people need money to do their economic businesses, they should somehow be able to obtain money somewhere. This doesn't mean to just donate them the money, but that when a bank deems them creditworthy, that the bank has the possibility to give them a credit. And so there should always be enough money around to do our payments that we want to do with money. However, you don't want inflation, so you don't want that a situation in which money loses its worth too quickly. You don't want deflation either, so you don't want money to appreciate ever more, because then people would probably not spend any money. Because if you think, well, for these 500 euros for which I could buy one phone today, I could buy a much better phone next year, or maybe two phones, then you might think twice about spending it today, and the economy will only work if you spend the money. So you don't want deflation, but you want some low inflation. And if you look at it internationally, you also want stable exchange rates, which is something very similar to what I explained before to you as individuals, then applying to international investors maybe, because if you invest in a different country, or if you perform trade with a different country and then the exchange rates between the two currencies fluctuate a lot, then your business has to grapple with great uncertainties. So if you today make a contract that you will buy 1,000 cars from France, and France and Germany is a bad example. Let's say you want to buy 1,000 cars from the United States, and these 1,000 cars are 10,000 euros each, or $10,000 each. Then you would expect that you will have to pay $10 million, and at the moment maybe these $10 million are the same as euros, so they are 10 million euros. However, you say, well, I promised to buy these cars next year, and then next year they deliver your cars and say, well, give me my $10,000, and now let's say the dollar has appreciated vis-a-vis the euro, and now $10 million are not 10 million euros anymore, but are now 15 million euros. Then this is of course bad for you, and so what you want is that these kind of relations are stable. And maybe that's also something you might experience when you are an exchange student in a different currency area. So if you are an exchange student in the United States and you have a budget of, I don't know, maybe 800 euros per month there, and then you will see that every time you withdraw money, it will always be some kind of currency speculation, because in one situation you withdraw $100 there and they will debit maybe 80 euros from your German bank account, and the next situation they might debit 120 euros from your German bank account, not because they're betraying you, but because the curses fluctuate. So what you want there is that they are not necessarily always the same, but that if they fluctuate, they do so in small amounts only. And what kind of tools do central banks have to reach these goals? It's first, they have the tool of increasing or lowering the interest rate at which they lend money or borrow money from commercial banks. I'm gonna say more about this in a minute. Secondly, they can also engage in buying or selling government debt on the secondary market at least. And finally, they also have the chance to regulate banking. So they can, for example, say that banks are only allowed to give credit and create money in a certain amount, and if they regulate this, they can also manage the money supply. And the idea is, by managing the money supply with these three tools, they can then regulate that there will always be enough liquidity, but not too much, so that there won't be inflation. And this idea has been challenged in recent years. However, it's still roughly how central banks and monetary policy works. The next is fiscal policy, and this is sometimes mixed up with monetary policy, but it's actually a quite different thing. So fiscal policy pertains not to the issuance of money by central banks, but it pertains to the government's budget, so the spending and the revenues of the government, and therefore also to the government's debt. So if you, for example, think about the United States, then the monetary policies, they will be performed by the Fed, which is the American Central Bank, and the fiscal policy is within the responsibility of the Treasury department, maybe, or that's at least where a lot of it happens. So what are the goals here? The goals are, you could say, public welfare and sustainable growth. So you want to manage your government spending and your government revenues and your debt in a way that, once again, the economy grows and as many people as possible benefit from it. And here I also want to emphasize what I at least think that the goal of fiscal policy is not, and this is not a general reduction of public debt. If you listen to media discourses and the talk of quite a few politicians in recent years, you might have gotten the impression that public debt is always bad and that we have to reduce it as aggressively as we can, and that is bad because the next generation will have to pay it, and when we take debt today to pay for a welfare state or for restarting the economy after the corona crisis, that the coming generations will have to pay for it, and it's very egotistical to do this at the moment. And this is a bad idea to think about public finance or about public debt. So there are a few ways you could argue this way. I want to sketch out two ways here. So the first relates to what I said on the last slide about the inequalities. It's once again, for every debt, there will always be, for every loan, there will always be someone who's borrowing, which also means that someone is saving money. So in general, you have the idea that it's good if households save money, because only if they save money, they can make big purchases. So you cannot buy a car from just your monthly income. You have to save money over a couple of months in order to buy a car, and maybe you will also have some unexpected expenses. So if your washing machine breaks down, your car breaks down, your computer breaks down, or all of this happens at the same time, then it's better for you to have some money saved. And also if some other hardship happens to you, or you lose your job, or someone in the family has a problem, in general it's good if people save some money. However, if households save some money, they have to put it somewhere. And just like some fantasy numbers, let's say for 20 million households in Germany, we want each of them to save on average like 50,000 euros. It's a lot of money, but let's say that's what we aim at. And if we multiply these 50,000 euros per household with the 20 million households, then you're somewhere in the vicinity of 1 trillion euros. And of course, these 1 trillion euros have to be somewhere if they save it. And where would they put it? Probably in one form or the other in a bank. So then this $1 trillion is in the banking system, and the banks have to do something with the money, and so someone has to suck it up. And ideally, they would even maybe have the interest of getting some interest on these savings. So you have to find someone who will borrow all this money, because what the customers effectively do is they give the bank a loan. So now the bank is indebted to the customers with this $1 trillion, or all the banks collectively. So they have very strong interest to place that money somewhere and to find someone else that they can give the loan. And one of the institutions that's very good at doing this is the government. So the bottom line here is, if we want a lot of households to do a lot of saving, then the government at the end will have to suck up a lot of this as public debt. The only other alternative would be that businesses go in massive debt, which can happen to some degree, but will not really solve the problem. So in general, we can say we want the government to have debt in order for people to be able to save money. Second argument is, when people say, well, the next generations have to repay this money, we also have to say, well, the next generations will also inherit the savings from their parents, not only the public debt, and they might also inherit the stuff that their parents bought from these savings, and they might also inherit directly the government bonds that are bought with it. So it's not that the money disappears and it's a black hole that will suck everything up. There's always, for every money, every euro that's there in the government's debt as a loan that they took, it's always, this money always is somewhere as an equivalent, and it would only be a big problem if all this money was lent from, was borrowed from somewhere abroad. The second argument is that it depends very much on what the government does with the loans that they take. So if they take the $1 trillion and then make big firework from it, that would probably not be a good idea. It would certainly be a very, very impressive firework. However, not even thinking about the CO2, the carbon emissions, it would probably not be a good investment. If, however, they take this money to build schools, to build roads, to build bridges, to build a railroad system, this could actually be used to build an ecologically more sustainable economy, and it might even help the businesses and individuals to become richer over the course of the next 20 or 30 years. And then if people are richer, they want to save more money and can pay more taxes. So it's not that it's something that is just there as a big backpack full of stones that the government has to carry around with them and will weaken them over the course of the time. It can also be the other way around. However, that all being said, I'm not saying that debt is never a problem, or that the government should take as many loans as possible, because there is this one word on the slide where it says it is about sustainable growth, and not all kind of public debt is sustainable. So if you are in a situation where you have to sacrifice a big portion of your government budget for interest payments, or if banks or individuals don't want to give you loans anymore, then you of course have a problem, and then your loan taking was not sustainable. However, if you stay within the sustainable realm, and it's not so easy to say where that is, then public debt is not the problem that you want to fight. So here, what are the tools that government has? Of course, they can manage their revenues, so they can raise or lower taxes, or they can manage their expenditures. So for example, expenditures on welfare state, on the education system, on the military, on public investments in infrastructure or in subsidies. And this together means that they are also managing their debt. The third policy field is macroeconomic policy concerning financial markets. So macroeconomic policy is generally the policy with which the government tries to influence the way the economy, the national economy, works. And one aspect of this is managing how financial markets work, because they are a part of the national economy. The goals here are once again to create and maintain a stable financial system. As I said before, without credit there will be no capitalism. So you want a financial system, and the financial system is mainly about providing credit and providing capital for investment, that individuals and households and companies that want to invest, and also the government that wants to invest, have access to capital and access to credit. So you want a credit system that is sufficiently dynamic, sufficiently big, sufficiently liquid to supply all of this. However, you don't want the financial system to be loaded with very risky operations that can then lead to a financial crisis. I'm going to talk about this a little bit later. What are the tools here? In general, you can say there are the possibilities of regulating and deregulating the market. So you very rule of the thumb kind of thing, You regulate if you think the risks are too big, and you deregulate if you think there is too little dynamic there, or if you're lobbied to deregulate. And then finally, there are also emergency measures that you can take as a government in the case of an economic crisis or a financial crisis, and these might include bailouts, so basically buying banks or nationalizing banks that have problems and spending billions on that. Now I want to discuss monetary policy a little bit more, because I think on one hand the textbook always mentions this thing with rising or lowering the interest rate, but never really explains it. Second, some of you asked questions about this in the first session when I discussed money. So the orthodox teaching for the last 50-60 years has been monetarism, which is associated with the name Milton Friedman, who made the case for this idea against Keynesianism, which prevailed beforehand, and this idea is prevailing since the 60s and 70s, first in the universities and then also in the central banks. The main idea here is that the central banks should be separated from the political control of the government. Of course, the government typically names the people who command the central bank. It might even define the goals that the central bank have. However, the day-to-day operation are then autonomous and separated from the government, because the idea is that the government will always be driven by short-term interest, and this will probably push some inflationary policy, because the government always wants to spend so much money and then they want the central bank to finance it, and this is a big taboo in monetarism. So you want the central bank to be separated from the government and also from the public interest, if you will, and thereby also from democracy. And the objective that central banks have, or the goal that they have, is to regulate the supply of money, or in other words, the total quantity or amount of money that's circulating out there. And to do this, they have the tools that I just mentioned before. So they can raise or lower the interest rate, they can buy government bonds, or they can on the secondary market, or they can regulate the way that the banks create money. I'm going to explain this a little bit more in a minute. And the goal is that the total quantity of money grows a little bit every year in order for a growing economy to always remain liquid, but not so much that there will be inflation. So it should always be growing at a very steady rate. And the idea that the radical monetarists have would be that we don't even need that many people in the central bank. We can easily do this as a calculation that a computer can make, so we don't really need people, and we want to insulate it from politics as good as we can. And this is what monetary policy is according to monetarism. And then there's also always the connection to the idea that in fiscal policy, government should limit their spending, and the spending should not exceed government revenues, because the idea is that government debt and too much government spending will always have inflationary effects and thereby bad effects. And of course, if government listens to all these advice, then they would hardly be able to fund the welfare state, but that's not typically the biggest worry of monetarists. And there have been a lot of challenges of this theory. One of the more recent and more interesting challenges is modern monetary theory, and one of you asked about this, and you might find this exaggerated, but just as an example that you can think about this in the exact opposite kind of way. So modern monetary theory starts with the idea that money is something that governments do create, which also kind of means that governments can create as much of it as they want to, and also let disappear as much of it as they want to. And therefore governments can also spend as much money as they want to, because they can simply create the money that they spend. So the idea here is not that governments first have to collect taxes to then have money that they can then spend reasonably. It's quite the opposite. They couldn't collect any tax money if they weren't to spend the money beforehand. So the idea here is that the government should spend enough money for full employment to have, so that we don't have any unemployed and that we have sufficient growth. And the government can simply do that because they also create the money. However, modern monetary theory does not say inflation doesn't exist. However, they say the problem with inflation is not too much government spending per se, or a too large quantity of money out there. Rather, they say that problems will only emerge if the government spends more money and creates more demand than the economy can provide. So if the government decides we spend such and such trillions of dollars to buy everyone in this country a great car, and then the German car industry is not able to supply all these great cars for every citizen, then there will be inflation, because the government just like pushed all this money on the market and then there isn't supply to meet this demand, and this will then cause inflation. So there has to be some limit to the spending, and also in order for the government not to be buried in debt, they have to make sure that the interest they pay on their debt does not exceed the growth rate of the economy, which is quite easy at the moment because the interest rate is negative and the growth rate is typically still a little bit positive, not this year but in general. And finally, if there would be too much money out there, then the government can still raise the taxes and thereby collect the money and thereby let it simply disappear. And this might seem completely silly to you, and I'm not totally convinced by it myself. However, what you can say is that while monetarism definitely undersells the capacity of government to do economic policy, modern monetary policy theory at least emphasizes that governments have some leverage and there's stuff that governments can do. Maybe they exaggerate it a little bit, and there are a lot of other approaches to monetary policy. However, this is not a lecture on monetary policy, so I just leave it there. One last thing I want to discuss about monetary policy is the interest rate. I do this here because it's mentioned quite frequently in the textbook, but I think they never really explain what this means and how it's supposed to work. So the interest rate that is being talked about there is typically the interest rate at which central banks lend to and borrow from commercial banks, and this also influences the interest rate at which banks themselves lend and borrow. And you probably see this in the news every couple of weeks or months, that one central bank discusses raising or lowering the interest rate, and even if the boss of the central bank only publicly ponders the idea that it might be the time to increase the interest rate next year, then it will be instantly news and markets will react to that. And what is the idea of this interest rate? So the idea is that by raising or lowering the interest rate, the central bank can control the money supply. So if you raise the interest rates, the supply of money will go down. If you lower the interest rates, the supply of money will go up. Why is that so? As I explained before, money is mostly created through credit. And if the interest rate goes down, it will have two effects. One, the commercial banks will think, well, I get free money from the central bank, so they might be interested to seek opportunities to give loan to others to make a profit on this, so that there is an incentive to engage in more lending. Secondly, it's also the case if they get the money cheaper from the central bank for lower credit rates, it might also be that they are willing to give out credits for lower credit rates, and then more people are willing to take these credits, individuals as well as banks. And if more credits are given, I explained this before, more money will create, so more money will circulate. And why would you engage in all this game? The idea here is that you use this to steer the economy to some degree. So you always want some growth in the economy, and you also typically aim at having a low inflation rate in the economy. So you want some inflation because it gives incentive to people and companies to spend and invest their money and just not to sit on it. However, you don't want inflation to be too high, because then there will be a lot of uncertainty in the economy, and this will not be good for economic activity. So you want some inflation. However, you also want some money out there in order for the economy to work and to grow. People have to take credits and people have to pay stuff. So you try to give out as money as you need in order for the economy to keep working. However, you want to stop giving out money if your inflation rate is above your aim, which is maybe 2% or so. So this is the general idea, and then there might also be the problem that if you have too low inflation rates and too much money, that this will create bubbles of investment. In the book, I think in chapter 3 probably, there is the explanation about the Dutch tulip bubble, and you can read up there what an economic bubble is. However, as you see, I marked all these things with question marks here, because this is how it's supposed to work in theory. In the last couple of years, it doesn't seem to be working this way, because the interest rate is at near zero for a decade now, roughly in the Eurozone, similar in the United States. Similar things happen in Japan even sooner. So there is, in theory, an unlimited supply of money out there, yet the economy doesn't grow and inflation doesn't start. And this was, of course, even the case long before the coronavirus crisis. So it seems that monetary policy and just giving out easy money is not the way that you can foster economic growth these days. What this is also connected to is the depreciation and appreciation of the currency. So again, if the central banks in the Eurozone and in the United States do the same thing with the credit rate, it probably will have no big effect on the exchange rate between the euro and the dollar. However, if the United States decides, well, we have some growth right now and we also have some inflation right now, so we will raise the inflation rate, while the European Central Bank will decide, well, growth in the Eurozone is not high enough and we don't have inflation, so we keep the interest rate low. This might be that the price of dollar goes up, the price of euros goes down, which means that if you are a European and want to go on holiday or on a semester abroad in the United States, you probably have to pack in more euros because your euros will be worth less in the United States. Of course, the opposite is true for Americans who come to Europe. And this is, of course, also true, and this is more important in global political economy, that if the currency of one country appreciates, so it's worth more, and the currency of another country depreciates, then it is good for different sectors and different actors in the economy. Export sectors typically always have an interest in their currency being being undervalued, so being worth less than those of other countries, because then their export goods will have lower prices on the international market and they can export more. As a consumer or as a sector of the economy that's mainly aiming at domestic demand and that still has to import some stuff, then you're more interested in having a strong currency, because with that you can buy more stuff abroad. So different sectors in the economy also have different interests here.